In this video, we are going to talk about monthly dividend stocks to buy. So before starting, please like this video and subscribe to this channel for our future updates. Despite recent developments, certain things have tragically remained the same. We all have monthly bills to pay. Pay your monthly bills, whether it's your mortgage, auto loan, or even your phone and utilities bills. Paychecks are normally sent every 2 weeks, so that's not a problem when we're working. Even in retirement, Social Security and, if you're lucky, pensions are paid monthly. But not in our investment portfolios, such as monthly dividend stocks. Dividend-paying stocks pay quarterly dividends, while most bonds pay twice a year. Portfolio income is lumpy due to the clustering of dividend and interest payments. Monthly dividend stocks, on the other hand, can help you better manage your cash flow. Here are some monthly dividend stocks to buy. So let's start. Number 10. Ecofin Sustainable and Social Impact Term Fund. $269.7 million in assets managed. Orphan stocks have merit. Certain companies or funds just don't have a typical buyer. Consider the Ecofin Social Impact Term Fund, TEAF, $15. In this fund, traditional energy infrastructure like pipelines meets green energy initiatives like solar panels. Other impact sectors include education and senior living. Over 68% of the portfolio is allocated to sustainable infrastructure, with 13% and 19% going to energy infrastructure. The fund is also varied in other ways. It also combines public and private investments. The remaining 48% is invested in private, non-traded enterprises. This lack of clear buyers explains why the fund trades at a 15% discount to net asset value. It's fine. We can buy this orphan stock, earn 6%, and wait for the NAV discount to close. And it will. The fund will dissolve in around 10 years, selling assets and paying investors cash. Buying and keeping this investment at a big discount seems obvious. Number 9. Prospect Capital. $3.5 billion market cap. Dividend yield, 8%. Consider Prospect Capital, PSEC, $8.97, for another high-yielding BDC. Prospect Capital, like most BDCs, lends to middle-market companies. The company has been publicly traded since 2004, thus it has survived 2 tumultuous decades. Prospect Capital trades at just 89% of book value. Of course, book value is subjective. But the 11% gives us some leeway. Even under modest assumptions, the company is selling for less than the value of its core portfolio. It likewise produces 8%. Insider purchases are generally positive. Buying stock with one's own money indicates dedication to the company and alignment of interests. So, in the last 2 years, the management team bought almost 29 million PSEC shares. Not executive stock grants. Insiders bought these shares individually in their brokerage accounts. Number 8. Main Street Capital. $3.2 billion market cap. 5.5% dividend yield. We know that Main Street was impacted harder than Wall Street. That's life. But what about BDCs? Here, Main Street is Wall Street. BDCs primarily fund middle-market companies through debt and equity. These are companies that have grown too big for bank loans and maintained earnings, but not big enough for a stock or bond IPO. BDCs exist to fill it. Main Street Capital, Maine, $46.61, is a top-notch BDC established in Houston. Lesser capable companies were less able to negotiate the lockdowns in the last 2 years. But the corporation endured, and its stock recently surpassed pre-pandemic highs. Main Street has a conservative monthly dividend policy, paying a modest monthly dividend and then issuing special dividends twice a year. This keeps Main Street out of difficulties and avoids the shame of a dividend decrease in years where earnings are down. Main Street's usual monthly dividend payout is 5.6%, excluding special dividends. Number 7. Broadmark Realty. $1.3 billion market cap. 8.6% dividend yield. In fact, Broadmark Realty, BRMK, $9.75, doesn't own mortgages or mortgage-backed securities. But it does a lot of the same. Broadmark administers a portfolio of deed of trust loans for real estate development and investment. Unlike AGNC or DINX, these mortgage REITs mostly trade standardized MBS. Instead, Broadmark deals with less liquid construction loans. But BRMK is a conservative. The portfolio's weighted average loan-to-value is only 60%. In other words, Broadmark would only lend $60,000 on a $100,000 home. In the case of a borrower default, the corporation has a large mistake margin. Broadmark now yields 8.6% at current prices. The company started paying a monthly dividend in late 2019 and sailed through the pandemic. Number 6. DINX Capital. Market value, $640.6 million. Dividend yield, 8.9%. Along the same lines, let's take a look at DINX Capital, DX, $17.47. Like AGNC, DINX is a mortgage REIT, though its portfolio is a little more diverse. Approximately 85% of its portfolio is invested in agency residential mortgage-backed securities, bonds made out of the mortgages of ordinary Americans, but it also has exposure to commercial mortgage-backed securities and a small allocation to non-agency securities. It's important to remember that the mortgage REIT sector was eviscerated by the COVID-19 bear market. When the world first went under lockdown, it wasn't immediately clear that millions of Americans would be able to continue paying their mortgages, which led investors to sell first and ask questions later. In the bloodbath that followed, many mortgage REITs took catastrophic losses, and some failed altogether. DINX is one of the survivors. And frankly, any mortgage REIT that could survive the upheaval of 2020 is one that can likely survive the apocalypse. Your risk of ruin should be very modest here. DINX trades at a slight discount to book value and sports a juicy 8.9% yield. We could see some volatility in the space if the Fed ever gets around to raising rates, but for now this looks like one of the best monthly dividend stocks to buy if you're looking to really pick up some yield. Number 5. AGNC Investment. $8.4 billion market cap. 9% dividend yield. AGNC Investment, AGNC $15.98, is a REIT, but it's not like Realty Income, Stag, or any of the other monthly dividend companies on this list. Rather than owning real estate, AGNC owns mortgage securities. It has the same tax benefits as a REIT, no federal income taxes if at least 90% of net revenue is distributed as dividends, but a significantly different return profile. Mortgage REITs, MREITs, are meant to generate income rather than capital gains. They are hence monster yielders. For example, AGNC generates 9%. Loudly say AGNC, doesn't it sound like agency? There's a reason. Fannie Mae, Freddie Mac, Ginnie Mae, or the Federal Home Loan Banks are the only issuers of agency mortgage-backed securities. This makes it one of the safest bets. Number 4. EPR Properties. $3.7 billion market cap. Dividend yield, 6.1%. The COVID-19 outbreak hit many landlords hard. But none was hammered like EPR Properties, EPR, $49.21. EPR's portfolio includes movie theaters, amusement parks, ski resorts, eat and play venues like Topgolf, and more. EPR focuses on experiences above stuff, which is a bad idea when social distance is the norm. Almost every EPR site was closed for a while, and attendance haven't returned to pre-COVID levels in many. Notably, the worst is behind EPR Properties, and the more regular life returns, the better for EPR's renters. Pre-pandemic, EPR was a reliable dividend payer. But with renters in a bind, the REIT cut its payout in 2020. With business conditions expected to improve in 2021, EPR restarted its monthly dividend in July, resulting in a 6.1% yield. When it comes to monthly dividend stocks, EPR is one of the best. Number 3. Gladstone Commercial. $838.2 million market cap. Dividend yield, 6.7%. Consider Gladstone Commercial, good, $22.49, for another grim industrial piece. We have a broad portfolio of logistics and light industrial properties. Industrial properties generate roughly 48% of its rental income, while office properties generate another 48%. The remaining 4% is split between retail properties, 3%, and medical offices, 1%. It's a well-diversified portfolio that has weathered the recent market turmoil. On September 30, 2021, the REIT had 127 properties in 27 states leased to 109 tenants. We have grown our portfolio 18% every year since our IPO in 2003, says management. Our occupancy is 97.7% and has never been below 95%. That's a good run. Gladstone Commercial has also been paying a monthly dividend since January 2005. Good presently yields 6.7%. Number 2. Stag Industrial. $7.6 billion market cap. 3.4% dividend yield. Realty Income was Amazon.com proof. But Stag Industrial, Stag, $42.77, benefits from the expansion of online commerce. Stag invests in warehouses and light industry. Those rundown warehouses near the airport with 18-wheelers continually coming and going? Stag acquires and holds property like that. E-commerce is unquestionably on the rise, and Stag is well positioned to benefit. Amazon.com is Stag's largest tenant, accounting for over 40% of its property. For obvious reasons, e-commerce soared. The impacts of that rise have faded as businesses reopen, but the trend is obvious. We're buying more online. But there's more to come. According to Statista, only 15% of retail sales are conducted online. The logistical industry is also highly fragmented, with Stag's management estimating a market value of roughly $1 trillion. That is, Stag is unlikely to run out of opportunities soon. Not at all. In the long run, it's one of the top monthly dividend stocks to purchase in 2022. This market competitive 3.4% yield. Number 1. Realty Income. $40.1 billion market cap. Dividend yield, 4.2%. No other stock has been more closely related with monthly dividends than Realty Income, $70.91. The monthly dividend company even trademarked its official nickname. Of course, Realty Income is a stock, and its share price fluctuates like any other. But it's still the closest thing to a bond in the stock market. It offers reliable recurring rental income from over 7,000 homes and 650 renters. Realty Income specializes in high-traffic retail properties that are recession-proof and Amazon.com proof. Amazon.com, AMZN, and other e-commerce behemoths may not be fully free of competition, but Realty Income gets close. Among its major tenants are 7-Eleven, Walgreens Boots Alliance, FedEx, and Home Depot. The portfolio had strong exposure to gyms and cinemas, making the pandemic difficult. But as the world returns to normal, Realty Income's COVID-19 risk decreases. Realty Income currently yields around 4.2%. Remember that the 10-year Treasury yields only 1.6%. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.